So you're reading the tape, you're reading order flow, you're weighing out whether or not that the market continuously keeps balancing and repricing, balancing, repricing. So it's permissible for it to trade up to this level here. It does so. So now what has happened right there? From here to here, I gotta change the color of this. We had this range back and forth between this candle's high to this candle's low. We trade all the way back up to this candle high, and then we leave the range here. There's no necessity to enter back into this range. So because this is a balanced price range, why doesn't it have the necessity for price to come back up into that pink area? Why shouldn't it go up there? Because the price has done what? It's delivered paint down, then up, then down. Consequent encroachment of the wick. That's where algorithmic smart money composite men engage right there. And we don't need it to come back up here because this candle went down to this low. And the next candle, it happens to be opening up here and delivers once more over top of that range. So what's occurring here? This balance range, balance price range, yes, it's balanced, but now we have a smaller balance price range here. It doesn't need to come back up into this area. It trades lower and then trades over top of it here again. We leave that range and we come back up. What can it do? What's permissible? Halfway. Halfway, which is also consequent encroachment of that wick. There's a convergence of factors coming there. When I'm looking at price, my eye's looking at all these things and I'm reading everything from each one of these candles. So when you're watching price, you're looking at it and you're deciphering, does the feedback that you're getting from price supporting the idea that it wants to keep going lower? The fact that we don't go back up into this area is great. The fact that the bodies are respecting the consequent encroachment of that wick and the mean threshold, because we're measuring bodies of candles here, both consequent encroachment and mean threshold converge at the same area, which is this level right there. Look. $41.00.75. That's the close and open of that candle. The small little variance in price, you have to allow for that. Don't let that scare you. Don't let it be a source of fear or anxiety. That's normal. That's a normal thing in price delivery. Get this off here. So now price goes up into that area. We want to see, and I would be saying if we were doing a live trade, I'd say we want to see it deliver and go lower now. It goes down. So what's it doing here? It takes out this low here. So now this low to this high here becomes what? A balanced price range. Because the market has delivered both directions of buy side and sell side. Between this here, our old range, down to this low here, the market trades back up to what? Consequent encroachment. So consequent encroachment becomes the high end of the new balanced price range. Because we've traced back that far, there's no need to worry back to here or this old low. It's already done its work by going back and forth between these two candles. Think about that paint analogy. Are you going to paint the same section of the wall 5 times? No, you're wasting paint. Price isn't going to waste time. Time is important to it. It only has so many trading hours in the day. So you take your eye and your attention. You don't want to do this when price is trading live because you'll miss what you're supposed to be focusing on. But you want to be referring to it while watching price. So again, we're thinking that the price is going to continuously go lower. The market trades back up into this consequent encroachment here, which is now the new high of the balanced price range. There's no necessity for it to trade higher. Does the willingness of price reflect wanting to go lower? Yes, it does. It takes out this low here, and then we come back up. What's permissible? If this is a balanced price range, it's painted price down, offered sell side, then it offered buy side, to the area where we're expecting to see price go to anyway, then it should go lower. It does. It leaves that price range. Can it go back up into this range? Yes. How far? Halfway. Because we're measuring bodies, we're looking at it through the lens of what? Mean threshold. So here is the mean threshold, 4097.50. That's what could reasonably be traded to, and it's permissible. It means it's allowed. You can expect that, and it doesn't upset anything. The market fails to go there, and what does it do? It trades lower than that low now. So we're expanding our range, and it breaks lower. We don't even need to go back up to mean threshold. We're looking for now any further advancement lower. What does this area here now become? Between mean threshold, which was never hit, this to this is your new balanced price range. Does market want to trade away from that? It does. But now we're late in the day. What time of day? 15:24. So it's 24 minutes after 3 New York local time. It's going to run. It's going to aggressively reach to the liquidity it's going to aim for the day. And then 20 minutes to 4, you want to be sitting and waiting for price to run on liquidity, because at 15 minutes of, if you haven't already seen it by then, it's going to really aggressively run on liquidity that has not seen or hasn't been tapped into. Meaning what? I told you the buy side liquidity would be right here. Where does it go? Right there. And now we're in a time of day where it's just going to trade listlessly now between this high and that low. But reading price and understanding the order flow is essentially what I'm showing you here. Every time we have an overlap of price. If sell side's offered, it means it's going down, a down candle. If you're bearish, you want to see that down close candle be redelivered with an up close price movement. And then back down. It does not need to close. It doesn't need to close with an up candle if it was a recent down close candle. So what do I mean by that? See how we have this down close candle here. Say the next candle opened up and we traded up and overlapped all of that and then went down and made a lower low. And so it would have a wick there. That's the same thing as what I'm saying. Is it has to have both. Every range between one price level and another to be determined and deemed efficiently delivered is between both price points, between any price point range in a price run. It has to offer both directions. It went down and up. Down, then up. Or if it starts with up first, it's up, then down. And it has to overlap the entire range of whatever has been delivered. If they deliver both directions, that's efficiently delivered price. When it doesn't do that, it creates these things like this, where you have a separation from one candle's low, one candle down, the next candle is a lower high than the previous candle's low on these 3 candles here. And that segment of price action in between becomes your fair value gap.